Autonation has just dropped a bombshell report, and the numbers inside are so alarming that they're sending shockwaves through every corner of the car industry. In fact, this data paints a brutally honest picture of what's really happening behind dealership doors. A picture that many automakers desperately hoped would stay hidden. According to Autonation's internal numbers, consumer demand has taken a dramatic turn, and dealers across the country are suddenly finding themselves in full-blown panic mode. Buyers aren't behaving the way they did over the last 3 years. The frenzy is over, the impulse buying is dead, and for the first time since 2020, shoppers are walking away from deals they would have taken instantly just months ago. Autonation's data shows a massive, unexpected shift in consumer behavior. People are researching longer, waiting longer, comparing more, and refusing to buy unless the discount is too good to ignore. And this change is happening so fast that dealers simply cannot adapt quickly enough. But the real shock comes from the used car market. Autonation's new data confirms what many analysts have feared. Used car prices are collapsing even faster than predictions, and the crash is accelerating. Their report shows record-breaking price declines across nearly every category. Sedans are falling the fastest, with some models shedding 20 to 30% of their value in just months. SUVs, once unstoppable, are now piling up on lots, and even trucks, the backbone of American dealerships, are finally cracking under pressure. Autonation has issued a quiet but clear warning to other dealers. Get ready, because the used car correction is just getting started. What's even more worrying is that some dealers are still pretending everything is fine, while Autonation's numbers show the exact opposite. The market is spiraling downward, and anyone ignoring the signals is about to get crushed. And then there's the inventory problem, the one nobody in the industry wants to talk about. Autonation's data reveals that dealership lots are quietly filling up again, almost like a slow-motion tidal wave. But here's the twist. It's not because production suddenly exploded. It's because cars simply aren't selling. Demand is drying up, and slow-selling models are beginning to stack up exactly like they did just before the 2008 collapse. Autonation calls this the silent buildup, a dangerous combination of weakening demand, stubborn pricing, and overstocked lots that could trigger a major market crash in the coming months. Dealers are drowning in vehicles they can't move, especially certain mid-size SUVs, overpriced EVs, and luxury trims that used to sell instantly, but now sit untouched for 60, 90, even 120 days. Behind the scenes, managers are panicking as interest costs skyrocket, and those carrying costs alone are torching dealer profits. But the suffering doesn't stop there. Autonation's trade-in data reveals a brutal truth. Millions of American car owners are now deeply underwater on their loans. Trade-in values are cratering compared to their 2021 and 2022 peaks, leaving families stuck with vehicles worth far less than what they owe. The report shows that negative equity, once a rare problem, is now becoming the norm. Some owners are walking into dealerships expecting strong trade-in offers, only to discover their car has lost $8,000, $10,000, even $15,000 from its peak value. Autonation's appraisal teams are seeing this tsunami of negative equity hit every day, and it's destroying the new car market because most people can't trade out without rolling losses into their next loan. It's a cycle that's choking demand and suffocating sales, and there's no sign of relief anytime soon. Meanwhile, new car sales are stalling even though automakers are offering the biggest discounts and incentives we've seen in nearly a decade. Autonation's data shows that even massive rebates, 0.9% APR deals, and record lease incentives aren't enough to bring buyers back. Ford, GM, Toyota, and even Tesla are facing the same painful reality. Incentives alone can't revive a market where consumers are scared, underwater, and burned out by high interest rates. This is exactly why industry insiders now believe 2026-2027 could be one of the most brutal downturns the auto market has seen since the Great Recession. OEMs are quietly preparing for a storm, cutting production targets, slowing EV plans, and bracing for a collapse in profit margins. Autonation's report also confirms something even more shocking. EV demand has officially hit a wall. Their data shows a staggering drop in EV inquiries, test drives, and actual purchases across the board. Hybrids are surging, gas vehicles are stabilizing, but EV interest has fallen off a cliff. Some EV models are sitting on lots for months, becoming toxic inventory dealers are begging manufacturers to fix. And while automakers continue to brag publicly about EV growth, Autonation's real-world numbers tell a completely different story. Buyers simply aren't interested right now. Behind closed doors, major automakers are already pivoting away from their EV-first strategies, focusing more on hybrids and fuel-efficient gas models because that's where the demand is actually showing up. Autonation's new data also reveals a stunning, and for some brands, terrifying list of vehicles that Americans simply refuse to buy right now. These models aren't just slow sellers, they're becoming what dealers call toxic inventory. Cars that lose value the longer they sit, drag down profits, and force dealers into desperate discounting. According to Autonation's internal tracking, several mid-sized sedans, slow-selling crossovers, and overpriced EVs are collecting dust on lots across the country. Some models have more than 120 days of inventory, a number that would have been unthinkable even 2 years ago. Certain automakers are quietly in crisis mode because they can't move these units no matter how many rebates or low APR deals they offer. It's a harsh reminder that brand loyalty means nothing when consumers are strapped for cash and expecting deals. For some models, the writing is already on the wall. Autonation's managers are privately saying these vehicles may need to be discontinued entirely if trends continue. But perhaps the biggest red flag in Autonation's report is the explosion of hidden dealer costs that most buyers never hear about. Service departments, once the most profitable part of dealerships, are slowing down as people delay repairs due to skyrocketing costs. Financing is drying up because lenders are tightening standards and raising rates. Insurance premiums, already at record highs, are crushing buyers so badly that some walk away from deals after learning what their new monthly insurance payment would be. And on top of all that, dealers are now losing money on more and more sales because they're forced to discount vehicles just to make room on the lot. Autonation's data shows that many dealers are entering a period where profitability is shrinking across the board, and those who rely heavily on new car sales may not survive the next downturn. All of this leads to Autonation's most stunning conclusion. The US car industry is showing clear signs of entering a major recession, one that experts say could mirror the 2008 collapse. Early warning signs are everywhere. Ballooning inventory, collapsing used car prices, falling demand, negative equity, and rising operational costs. Autonation's executives are sounding the alarm, saying the industry is heading into a perfect storm where consumers can't afford cars, dealers can't afford inventory, and automakers can't afford production slowdowns. The fear inside dealerships is palpable. Managers are whispering about closing stores, cutting staff, and bracing for a brutal 2026-2027 period that may reshape the entire industry. Some believe the correction will be mild, but Autonation's numbers say otherwise. The severity of this downturn is building quietly, just beneath the surface. Yet for buyers, Autonation's report ends with a surprising twist. This storm could bring massive deals unlike anything seen in over a decade. As inventory piles up and dealers get desperate, prices will eventually hit rock bottom. Autonation predicts that the biggest discounts will arrive when the 2025 and 2026 model year overstock peaks, creating the perfect buying window for shoppers who are patient. Trucks and luxury SUVs are expected to see major discounts first, followed by EVs and slower selling mid-size SUVs. And while the correction is painful for the industry, it could be a once-in-a-generation opportunity for smart buyers who know when to strike. According to Autonation's forecast, the best deals haven't arrived yet, but they're coming. And when they hit, they're going to shake the entire car market to its core. But Autonation's analysts say the biggest story isn't just the discounts that are coming, it's the psychological shift happening among American car buyers. For years, consumers were conditioned to believe cars would only get more expensive, that shortages were permanent, and that paying thousands over MSRP was normal. But now, that mindset has flipped completely. Buyers are pushing back harder than ever. They're refusing to accept inflated pricing, refusing to finance at insane interest rates, and refusing to settle for vehicles that don't offer real value. Autonation's customer behavior charts show a dramatic spike in walkaways, where shoppers spend hours at a dealership only to leave without buying. This is something dealers haven't seen on this scale in over a decade, and it's the clearest sign yet that the power dynamic in the car market is shifting back to the consumer, but only because the market is breaking at the seams. On the automaker side, the panic is becoming impossible to hide. Autonation's new data has forced major brands to reevaluate everything from production pacing to marketing budgets. Some manufacturers are already cutting future model launches, shelving EV-only projects, and reshuffling entire product lineups to avoid drowning in unsold vehicles. Executives from Ford, GM, and Stellantis are reportedly holding emergency meetings to rethink 2026 and 2027 strategies because AutoNation's numbers show exactly how bad demand might get. Meanwhile, Toyota, Honda, and Hyundai are preparing for a different kind of crisis, one where even their historically reliable, fast-selling models begin to stagnate due to consumer financial pressure. Automakers are now realizing that they can't rely on old strategies anymore. The market has changed, buyers have changed, and unless they adapt, the next 2 years could be devastating. Dealers across the country are already feeling that pressure in ways they haven't felt since 2008. AutoNation's financial breakdown reveals how rising floor plan interest costs are hammering dealership profits. Every day a car sits on the lot, dealers bleed money. When inventory was tight, this wasn't a problem, but now that lots are swelling again, dealers are paying thousands, sometimes tens of thousands, per month just to hold unsold cars. Add shrinking margins, failing incentives, and rising operational costs, and many dealerships are approaching a breaking point. Some are cutting staff quietly, others are slashing hours. A few are even considering consolidating stores to survive the coming collapse. If the current trends continue, AutoNation believes dozens, possibly hundreds, of independent dealerships could shut down entirely in the next 24 months. And then there's the looming threat of consumer credit tightening, which AutoNation says could become the final blow. Financing has already become more difficult, but their data shows the real tightening hasn't even started yet. Lenders are preparing for higher default risks, especially from buyers who stretched their budgets during the 2020-2023 price surge and are now underwater. AutoNation's forecast warns that if banks pull back on auto lending even slightly, the entire car market could enter a deep freeze. Deal approvals would plummet, subprime buyers would be locked out, and even qualified borrowers would struggle to secure favorable terms. This scenario is the nightmare dealers fear most, a market where people want to buy but can't get approved, turning today's slowdown into tomorrow's crash. Even auction data in AutoNation's report is signaling danger ahead. Wholesale prices are down, inventory is up, and demand at dealer auctions has collapsed. Vehicles that once sparked bidding wars now get ignored entirely. Trucks that used to be auction gold are suddenly selling below reserve prices. And EVs, dealers don't even want to touch them unless the discounts are enormous. AutoNation's auction channels are showing the most dramatic softening since 2009, and that's often the leading indicator of what's coming for retail buyers. When auctions slump, the retail collapse usually follows within months. AutoNation's economists say the scariest part of this downturn isn't what's happening right now, it's what's about to happen next. Their long-range forecasting models point to a dangerous convergence of trends in late 2025 and early 2026. Rising delinquencies, declining trade-in values, falling retail demand, and accelerating layoffs across industries tied to auto manufacturing. This isn't just a dealership problem anymore. AutoNation warns that the slowdown is beginning to spread into parts suppliers, transport companies, finance departments, and even factory operations. If the current trajectory continues, automakers may be forced to reduce production far more aggressively than they're publicly admitting. That could trigger a domino effect across the entire US economy, impacting everything from steel plants to chip manufacturers. AutoNation's internal notes even referred to it as a chain reaction recession, one that starts quietly in the auto sector before radiating outward. But what's even more alarming is how quickly consumer confidence has flipped. AutoNation's latest surveys show that buyers who were excited to purchase a vehicle 6 months ago are now delaying their plans indefinitely. The number of shoppers saying they're waiting for lower prices has hit its highest level since the Great Recession. High interest rates aren't helping either. Buyers see a 7% or 8% APR and immediately walk away. AutoNation's team reports that sales staff are spending twice as long with each customer but closing fewer deals than ever. It's the type of consumer paralysis that usually only happens during major economic downturns, and now it's happening even while the broader economy still appears stable on the surface. Meanwhile, the divide between what automakers want the market to be and what the market actually is has never been wider. Many companies are still pushing EV-heavy strategies in public, insisting demand is strong, but AutoNation's private data shows a starkly different reality. EV test drives are down, EV leads are down, EV conversions from inquiry to sale are collapsing. And on top of that, many EV owners are trading out due to high repair costs, long wait times for parts, and charging frustrations that weren't problems 5 years ago. Automakers are still pretending the EV enthusiasm of 2021 is alive, but But Autonation's CEO has already told investors that consumer expectations have dramatically recalibrated. In other words, people want hybrids or efficient gas cars, not expensive EVs that dealers can't move. This demand collapse for certain models is already beginning to force manufacturers into crisis mode decision making. Autonation's brand level analysis shows exactly which companies are bracing for impact. Ford, for example, is quietly slowing production targets on several EV models while ramping up hybrid plans. GM is facing a mountain of unsold midsize crossovers that were supposed to dominate in 2024 and 2025, but are now sitting untouched. Stellantis has multiple models with 150 plus days of inventory, making them some of the most overstocked vehicles in America. Even Toyota, usually insulated from market chaos, is starting to see slower movement on certain trims due to high pricing and limited incentives. Autonation's data makes one thing painfully clear: the old industry assumptions no longer apply. The market is in transition, and the companies that don't pivot will pay a heavy price. But the most jaw-dropping chart in the entire Autonation report shows the tidal wave of price cuts that's coming. The company's analysts predict that by late 2025 and early 2026, dealerships will be forced into the most aggressive discounting cycle since 2009. Not because they want to, but because they won't have a choice. With inventory swelling and demand shrinking, price cuts will become the only way to keep vehicles moving. Autonation estimates that some trucks and SUVs could see $8,000 to $12,000 off MSRP. EVs may drop even more, and luxury brands could be hit hardest with deep, painful cuts that erase profit margins. For buyers, this will be a golden opportunity, but for dealers, it will be a fight for survival. And according to Autonation's internal memos, the worst part is that this pricing collapse may last for years, not months. If the market continues weakening at its current rate, the auto industry could experience a long, grinding downturn where both new and used car values continue falling well into 2027. That would reshape everything: financing, insurance, trade-ins, model planning, even how cars are manufactured. Many industry veterans who lived through 2008 say the current situation feels eerily familiar, but Autonation's data suggests the coming downturn could be even more severe because the bubble was far larger and built on more fragile foundations. Autonation's analysts say that the buyers who prepare right now will be the ones who benefit the most from the historic market reset that's coming. Their report outlines a quiet but powerful shift. Instead of rushing into purchases, customers are beginning to strategize, watching price trends, monitoring incentives, and tracking inventory levels before making a move. For the first time in years, buyers hold the leverage, and Autonation believes this shift will only grow stronger. They recommend that shoppers avoid impulse buying, avoid stretching their budgets, and most importantly, avoid locking into long-term loans on vehicles that will likely lose thousands more in value over the next 12 to 24 months. It's essentially a buyer's playbook for navigating a collapsing market, and the most disciplined shoppers could walk away with deals the industry hasn't seen since the post-2008 liquidation era. The report also breaks down which vehicle segments will crack first and hardest. Full-size trucks, which were once immune to market turbulence, are now showing early signs of weakening as supply surges and demand softens. Autonation expects these to be among the first models to receive deep discounts, especially from Ford, Ram, and GM. Meanwhile, midsize and compact SUVs, once considered the safe bet for families, are becoming dangerously oversaturated. Autonation predicts that by early 2026, these vehicles could face price cuts so aggressive that used values might crash even faster. And then there are EVs, which are quickly becoming a ticking time bomb. With slowing demand, mounting dealer losses, and inventory piling up, Autonation believes EV price cuts will be the steepest of all, especially for models priced above $50,000. But what's truly shocking is the automaker by automaker breakdown Autonation included in its internal briefing. Ford is bracing for a correction that could slash margins across several key models. GM is deeply concerned about unsold inventory accumulating across the Midwest and Southeast. Stellantis faces what Autonation calls a critical risk scenario, with certain models becoming liabilities instead of assets. Tesla is grappling with softening demand and growing competition from hybrid-focused brands. And even Toyota, despite its strong fundamentals, is preparing for potential slowdowns in certain segments. The takeaway from Autonation's internal analysis is brutally clear. Every automaker, regardless of reputation or past dominance, is vulnerable in the coming downturn. Autonation's data also exposes the emotional shift happening among dealership staff, something rarely talked about publicly. Many sales teams are becoming demoralized as closing rates drop and walkouts rise. Managers are holding emergency meetings to train employees on new negotiation tactics because the old strategies simply aren't working anymore. Finance departments are stressed as lenders tighten standards, making approvals harder and deals more fragile. Some service centers, once the lifeblood of dealership revenue, are experiencing a noticeable slowdown as customers delay maintenance. Autonation describes the atmosphere as a quiet anxiety, one that's growing each month as more signs point toward an industry-wide contraction. Perhaps the most telling detail in Autonation's entire report is the section titled "The Beginning of a Down Cycle." In this section, the company outlines how every major indicator, inventory levels, credit availability, consumer behavior, incentive effectiveness, and trade-in valuations, is moving in the exact same direction as the months leading up to the 2008 collapse. Autonation stops short of saying a full-scale crisis is guaranteed, but their messaging is clear. The industry is heading toward the most significant correction in over a decade, and most players are not prepared. But amidst all this chaos, Autonation says something surprising. There will be winners. The buyers who wait, the buyers who research, the buyers who refuse bad deals. These consumers will come out on top as prices sink, incentives explode, and dealers slash profit margins just to stay afloat. Autonation predicts that the second half of 2025 and all of 2026 will be the golden window for buyers ready to take advantage of a once-in-a-generation collapse in car prices. Those who jump too early, they'll be stuck watching prices fall even lower after they buy. And inside Autonation's headquarters, executives are preparing for what they call a market reset, a period that will permanently change how cars are priced, how dealers operate, and how consumers buy. If their forecast is accurate, the next 2 years could redefine the entire automotive landscape in ways that the industry has never seen before.